This podcast includes content created using artificial intelligence tools. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance. Welcome to the Luxembourg Fundcast.
Before we continue, we'd like to mention that the Luxembourg Fundcast is created and produced by Bertrand Mariot, a practicing regulatory lawyer admitted to the Luxembourg and Paris bars. The mission of this podcast is to bring clear, free, and reliable information sourced from official references that are carefully curated and continually updated and refined through high-standard, evolving prompt engineering on Luxembourg's financial regulation and investment funds to professionals and anyone interested in the Luxembourg Financial Center.
Okay, so today we're diving deep into something really fundamental. It crops up all the time in corporate governance for a Luxembourg Société Anonyme, an SA.
Right.
And that's the whole process around managing a director's conflict of interest, meticulously managing it, I should say.
Absolutely. It sounds technical, maybe a bit dry, but it's actually where, the rubber meets the road. Legal rules, commercial reality, personal integrity, they all collide here.
Exactly. Every single board, honestly, will face this sooner or later. You really need to understand the ins and outs. So our mission for this deep dive is basically to give you that kind of masterclass. We're going to focus hard on the exact steps, the sort of legal choreography required by Article 441-7 of the amended Law of 10, August 1915, on commercial companies.
The 1915 law, yeah. We'll just call it that for short, probably.
Good idea. Saves a mouthful. And just for clarity, everything we're discussing today, all the analysis, it's based on the information we have as of today, August 9th, 2025.
Crucial context, that date. So yeah, our focus today, it's all about the practical side, how you actually manage these conflicts day to day, what the law really requires, why getting the paperwork right is so vital.
The documentation.
Absolutely critical. And also maybe touching on the strategic upside, how good governance here can actually be a benefit. So we've kind of boiled it down to three main takeaways we really want you to remember. Okay, takeaway number one, and this is fundamental. Article 441-7 is essentially a procedural safe harbor. It's not a flat-out ban.
Right. That's a key distinction.
It really is. What it means for you, if you're a director or involved in governance, is that Luxembourg law isn't trying to stop every transaction where a director might have a conflict. I mean, think about it. That would just paralyze business, wouldn't it?
Completely.
Yeah.
Especially in finance, with all the connections.
Exactly. Instead, the law provides a very specific, very strict mandatory procedure. Think of it like a defined pathway you must follow to make that conflicted transaction legally valid. It's actually quite pragmatic when you think about it. It acknowledges that conflicts happen. They're often unavoidable in the real world, especially with complex group structures or interlocking directorships. The genius here is giving a clear way through it.
Rather than just saying no.
Precisely. So, applying this procedure meticulously, it's not just box ticking. It's actually what enables your company to do business, potentially very valuable business, in a way that's legally sound and defensible. It's the bridge, not the barrier. But you have to cross it exactly the right way.
Otherwise, the whole thing could collapse later.
Absolutely. Even the best deal, best intentions could be nullified. Which leads us straight into takeaway number two.
Okay.
Your board minutes. They are your definitive legal shield. And I really can't emphasize that enough. These are not just, quick notes.
That's just an admin task.
Not at all. When it comes to conflicts, they become the primary irrefutable proof that the board acted correctly. Drafting these minutes well, with real precision, it's honestly an art form, a critical skill.
For the company secretary, especially.
Absolutely. Or whoever is responsible. Because these minutes are what directly protect individual directors from challenges later on, and crucially, from personal liability.
That's the big one. Personal liability.
It is. When scrutiny comes, shareholders, regulators, maybe even a court, those well-drafted minutes are your factual, legally robust defense, your audit trail, your proof. Imagine trying to defend a decision years later. Memories fade, people move on.
Without the minutes, you're exposed.
Totally exposed. With them, you stand on solid ground.
Okay, so takeaway 3, this sounds a bit ominous, the minefield.
Yes, perhaps a bit dramatic, but it captures the risk. It's about the normal conditions exception. So Article 441-7 does have this carve-out. It says the whole procedure doesn't apply to current operations concluded under normal conditions.
Which sounds useful, right? A shortcut.
It sounds useful, exactly. But here's the massive catch, the mine in the minefield. The law of 1915 gives absolutely zero definition of current or normal conditions.
Ah, okay, so it's subjective.
Hugely subjective. What's current for one company might not be for another. What are normal conditions? Normal historically for this company. Normal for the industry benchmark. Normal given today's market. The law just doesn't say.
So you're making a judgment call.
A high-stakes judgment call, because if a court looks at it later and disagrees with your assessment and says, actually, no, that wasn't normal, the whole decision based on that exception could be annulled.
Voided. Wow.
Voided contract, unwound deal, reversed investment. The potential damage, financial and reputational, is just catastrophic. So the really prudent board, they tread very, very carefully here.
You don't just jump at the exception.
No way.
Right.
If there's even a sliver of doubt, is this really current and normal?
Yeah.
The only safe harbor, the only truly defensible route, is to follow the full Article 441-7 procedure. It might take a few extra minutes, but it avoids potentially massive legal risk down the road. Better safe than sorry, really.
Those are three really clear, really vital takeaways.
Yeah.
Okay, let's dig deeper now into the core legal framework itself. Article 441-7, that's our starting point.
Cornerstone, yeah.
At its absolute heart, it says any director, if they have a direct or indirect financial interest that's opposed to the company's interest in a specific transaction, that transaction is up for board approval, they must declare it.
Must declare. Non-negotiable.
And here's that crucial nuance we touched on, something that sometimes catches people out, especially if they're used to, say, common law systems. The law is very specific. It talks about a patrimonial interest, un intérêt de nature patrimoniale opposé.
Patrimonial, financial, essentially.
Exactly. It's about a potential financial gain or loss for the director personally that directly clashes with the company's financial interest in that deal. And this definition deliberately excludes things like purely moral connections or emotional ties or even family relationships,
Unless those connections create a direct financial consequence for the director.
Precisely. Let's use that example again. Say our fictional SA, Luxinvest Global, is appointing a senior exec. Director Elena Rossi's son is a candidate. Is she automatically conflicted under Article 441-7?
Surprisingly, perhaps the answer is likely no, not automatically.
Right, because her son getting the job, getting a salary, that doesn't directly put money in her pocket or take it out, in opposition to the company's interest in hiring the best person.
Now, from a broader governance perspective, maybe best practice, she might choose to recuse herself anyway, just to avoid any perception issues.
Right. Good governance might suggest that. But legally, under this specific article, if there's no opposing patrimonial interest for her, the Article 441-7 procedure isn't technically triggered, it's a narrow focus.
It is. And understanding that patrimonial aspect is key to figuring out the two main forms this opposing interest takes: direct and indirect.
Okay, let's unpack those. Direct first.
Yeah, direct interest is usually the easier one to spot. It's pretty straightforward. It means there's an immediate, obvious, personal financial gain or loss for the director that is directly opposite to what the company wants financially from the deal.
Like the example of Director Rossi owning the building the company wants to buy.
Exactly. Luxinvest Global wants to buy a new office building. Turns out, Director Rossi owns that exact building. Boom. Direct conflict.
Because she wants the highest price, the company wants the lowest.
Precisely. Her personal financial gain is directly inversely related to the company's financial objective. It's a classic clear-cut case. Her interest and the company's interest are fundamentally opposed on a purely financial level.
Makes sense. So what about indirect interest? That sounds trickier.
It can be, yeah. It requires a bit more scrutiny, but it's legally just as significant. An indirect interest isn't about the director being personally involved in the transaction directly, but rather through some connection, an associated company, maybe a significant relationship that brings them a financial benefit.
Okay, give us an example.
Right. Let's say Luxinvest Global is about to sign a big IT service contract, maybe cloud services, software development, something major, with a company called Innovate Tech SARL. Now, Director Rossi isn't selling the service herself, but what if she owns, say, 25% of Innovate Tech? Or maybe she sits on Innovate Tech's board, too.
Okay. I see where this is going.
Then you have an indirect conflict. Her personal wealth is tied to how well Innovate Tech does. So she has a vested interest in Innovate Tech getting the best possible deal from Luxinvest Global, Maybe higher fees, longer terms, looser service levels.
Which directly conflicts with Luxembourg Global wanting the best deal for itself, lowest cost, best service, etc.
Exactly. Her financial gain isn't cash directly from Luxembourg Global into her pocket from this deal, but it flows indirectly through the increased value or profit of Innovate Tech in which she has a stake. It's about tracing that financial connection, even if it takes a step or two.
That's a great clarification. So we've covered the patrimonial interest, direct and indirect,
Yeah.
and the why, protecting the company's interest. What about the who and when? Who exactly has to follow this, and when does it kick in?
Good questions. Let's start with the who. The net is cast pretty wide here, which makes sense for good governance. First and foremost, it binds all members of the board of directors, the administrators, every single one. Yep. But it also explicitly includes the permanent representative of a corporate director. You see this a lot in Luxembourg funds and a management company acting as a director, represented by an individual. That individual representative is bound by Article 441-7, just like an individual director.
Okay, that makes sense. They're acting in the director role.
Precisely. And then, importantly, it also extends to the délégués à la gestion journalière, the daily managers.
The day-to-day management.
Exactly. But only when they face a conflict related to a decision that falls within their specific area of delegated authority. So, if a daily manager has the power to sign off on certain operational contracts, and one of those contracts involves a personal conflicting interest for them.
Like contracting with their spouse's company, maybe, if it gives them a financial benefit.
Potentially, yes, if there's an opposing patrimonial interest for the manager. In that situation, they too have to follow the conflict declaration and recusal process for that specific decision. It ensures conflicts are managed wherever financial decisions are actually being made.
Right, not just at the very top board level.
Yeah.
So that's the who. What about the when? When did this whole procedure get triggered?
It's triggered by any operation or transaction. The law uses the term operation that is formally put to the board for a decision for approval.
And operation sounds quite broad.
It is deliberately broad. It's definitely not just about signing a simple purchase order. We're talking about any significant corporate action. Major investments, selling assets, buying another company, taking on substantial debt, issuing complex financial products, basically any decision needing board approval that has a real financial impact on the company.
So if it involves money and needs a board resolution, Article 441-7 might apply.
That's a good rule of thumb, yeah. And remember, this whole thing is tied directly to the board's formal collegiate decision-making process.
Collegiate meaning collect.
Exactly. The board is supposed to act as a unified body. Decisions emerge from discussion, debate, shared viewpoints, and a collective vote, not from one director pushing their personal agenda. Article 441R7 is designed specifically to protect the integrity of that collective process from being skewed by an individual's private financial interests. It keeps the focus purely on the company's best interest.
Okay, that framework is clear. Now let's get really practical. The corporate governance playbook, as you called it, first step. The declaration itself, how does that actually work?
Right, the art of the declaration. The absolute first move belongs to the director who has the conflict. They must speak up.
Before the discussion starts.
Absolutely critical. Before any deliberation on that specific agenda item begins, it can't be an afterthought, can't be mentioned halfway through the debate, upfront and proactive. Now, while it's the director's personal duty to declare,
The whole board needs to make sure it happens.
yes, exactly. There's a collective responsibility for ensuring the process is handled correctly. And typically, this falls to the chair, often working closely with the company secretary, to guide the process smoothly.
So best practice would be.
Best practice. The chair, probably prompted by the company secretary, should make it routine. At the start of the meeting or before tackling sensitive items, just ask. Any interests to declare regarding today's agenda?
Takes the awkwardness out of it.
Completely. It shifts it from feeling like a personal confession to just being a normal point of order. It signals a mature governance culture where transparency is just expected. Then, once declared verbally, the director has to ensure it gets formally recorded in the minutes. That written record is non-negotiable.
Which brings us back to those crucial minutes. You call them the legal shield. Let's really unpack how to master them. This sounds like the nitty-gritty.
It absolutely is, because again, these minutes aren't just notes. They are your definitive legal evidence of compliance, your shield against liability. The language must be precise, unambiguous, no wiggle room.
Okay, so walk us through that best practice sequence for the minutes, using our Luxinvest global example, buying the building from Director Rossi.
Right, so Miss Rossi has identified her conflict.
First step, record the declaration. How should that look?
You need wording like this. Mrs. Elena Rossi declared that, pursuant to Article 441-7 of the Law of 1915, she possesses an opposing patrimonial interest concerning the proposed acquisition of the office building at address. The nature of this interest, being her personal ownership of said property, was fully disclosed to the board.
Very specific.
Yeah.
Cites the article, the transaction, the interest.
Exactly, and critically, it continues. Consequently, Mrs. Rossi stated she would abstain from participating in both the deliberation and the subsequent vote on this agenda item, both deliberation and vote.
Crucial. Okay, step 2, the recusal.
Immediately after the declaration, you need to formalize her withdrawal, something like, Mrs. Rossi thereopon recused herself from the discussion and the vote concerning this item.
And you mentioned adding detail about how she recused.
Highly recommended for robustness. Add, Mrs. Rossi physically exited the meeting room at time and remained outside for the duration of the discussion and vote on this item. Or, if it's virtual, Mrs. Rossi was disconnected from the conference call at time and rejoined after the vote on this item was concluded. Leaves zero doubt about non-participation.
Got it. Step 3, the deliberation.
Once she's out, the minutes must state clearly. The remaining members of the board then proceeded to deliberate thoroughly on the proposed acquisition of the office building. This confirms the discussion happened only among the unconflicted directors.
And finally, step 4, the resolution.
This records the actual decision, making it clear who made it. Following extensive deliberation, it was resolved by the unanimous decision of the unconflicted members of the board to approve the acquisition of the office building located at address from Ms. Elena Rossi, under the terms outlined in the board documentation, these terms having been deemed to be in the best interest of Luxinvest Global.
Okay, that sequence is crystal clear. Declaration, recusal, deliberation, resolution, all precisely documented. But why is just saying she abstained not enough? That feels like a common shortcut.
It feels like it, but it's a dangerous one under Luxembourg law.
Yeah.
Legally insufficient. Why? Because abstain only refers to the vote. It says nothing about whether she participated in the deliberation that led up to the vote.
So she can still influence the discussion even if she doesn't vote.
Exactly. She could subtly steer the conversation, offer opinions, provide helpful context, all while planning to simply abstain at the end. That compromises the integrity of the collective decision just as much. The detailed wording proves she didn't participate in the discussion or the vote. It proves what wasn't done as well as what was. That's why it's an ironclad shield.
That makes perfect sense. The detail matters immensely.
Immensely. Now, this need for documentation doesn't stop inside the boardroom. There's another layer. Shareholder accountability.
Okay, what does the board need to tell the shareholders?
The board is legally required to present a special report detailing all transactions where Article 441-7 was applied. This report goes to the next general meeting of shareholders held after those board decisions were made.
And what's in this special report?
It needs to be factual and clear. It should summarize the transaction itself, buying the building from Rossi. It must state the nature of the conflict, her ownership, and it needs to record the board's decision approved by the unconflicted members on specific terms.
So full transparency to the owners.
Precisely. And the timing is also key. The special report has to be presented to the shareholders before they vote on any other resolutions at that meeting, like approving accounts or appointing auditors.
So they have this specific information before making other key decisions.
Exactly. It ensures shareholders are fully informed about how these potentially sensitive transactions are handled, allowing them to exercise their oversight role effectively. It's a cornerstone of trust between the board and the company's owners.
Right. Okay, we've covered the declaration, the minutes, the shareholder report. Now let's circle back to that minefield you mentioned earlier, the current operations exception. Opération courante conclue dans des conditions normales.
The tricky one, yes.
So the law says Article 441-7 doesn't apply if a transaction is current and done under normal conditions. But the big problem is
no definition. The law gives us nothing to work with on what current means or what normal conditions look like. It's a massive gray area.
which creates huge subjectivity.
Exactly. What feels current or normal to one director or even one board might look completely different to another director, an auditor, or, crucially, a judge looking back with hindsight. Is it normal for this company? the sector, given market volatility, who knows?
And the risk if you get that judgment wrong.
Annulment. A court could simply say, nope, that wasn't current and normal in our view, and invalidate the entire board decision.
Leading to chaos. Void contracts, unwound deals.
Total chaos, massive financial loss, legal battles, reputational damage. It's the nightmare scenario for any board.
So relying on this exception is basically playing with fire.
It's a very high-risk strategy. A prudent board focused on risk management will be extremely cautious. If you do consider using it, you absolutely must document why you think it qualifies.
Build case in the minutes.
Yes, you'd need to spell out the rationale, referencing standard market terms, maybe, pointing to consistent past practice, showing it's a low-value routine item. You need to create a strong justification. But even then,
Risk remains.
risk absolutely remains. So the bottom line really is, if there is any doubt at all, and given the lack of definition, there often will be, the only truly safe path is the full Article 441(7) procedure.
Declare, recuse, deliberate without the conflicted director, minute everything precisely.
That's it. The small amount of extra effort involved pales in comparison to the potential catastrophe of getting the exception wrong. Don't gamble with legal certainty.
That's very clear advice. This careful approach leads nicely into the strategic side of things, doesn't it? This isn't just about avoiding disaster. Good practice here can actually be a strength.
Absolutely. Let's think about that internal dynamic first. The art of internal negotiation when a conflict arises. The governance professional's role here is key.
Company secretary, legal counsel.
Exactly. Their job isn't to be the compliance police, it's to be a trusted advisor, guiding the board through the process smoothly. Facilitating, not enforcing.
Because the procedure actually protects people.
Yes, that's the crucial reframing. It's protective, not punitive. It protects the conflicted director by showing they acted properly, shielding them from accusations and liability.
Okay.
It protects the other directors by ensuring the decision they make is legally sound and untainted, gives them confidence.
Right.
And it protects the company's transaction itself, making it legally robust and much harder to challenge later. So guiding the board through this isn't about creating hurdles, it's about reinforcing trust and allowing business to happen safely and legally. It prevents problems before they even start.
That protective, not punitive angle is really powerful. And it makes the cost-benefit analysis pretty stark, doesn't it? The cost of getting it wrong versus the price of doing it right.
Extremely stark. Let's be blunt about the costs of failure. We mentioned annulment, a court voiding the decision. Imagine the commercial disruption, the financial unwind, the reputation hit. It's potentially devastating.
And then there's the personal liability risk for directors.
Yes. Directors who participated improperly, didn't ensure recusal, didn't mine it correctly can be held personally and jointly liable for the company's losses. Their personal assets could be on the line, their careers ruined. It's a massive, massive risk.
So compared to that potential catastrophe, what's the price of excellence? What does doing it right actually cost?
Honestly, minimal. It's primarily board time, a few extra minutes in a meeting for the declaration, the recusal, the careful minuting. Maybe in really complex cases, the cost of getting a quick external legal opinion for extra certainty.
So a bit of time, maybe a small legal fee in some cases?
That's basically it. And when you weigh that against annulment, disruption, personal liability, it's not an expense, it's an investment. A necessary investment in risk mitigation, legal certainty, and the company's long-term health.
An investment in a secure foundation.
Beautifully put. Which leads to our final strategic point.
Yeah.
This isn't just about defense. Rigorous, transparent conflict management is actually a unique selling point, a competitive advantage.
How so?
Well, think about it. A company that consistently demonstrates this level of procedural integrity sends a powerful signal to the market, to potential investors, especially institutional ones, to partners, even to potential employees.
It signals professionalism, trustworthiness.
Exactly. It says, this company is well-managed, controls its risks, operates ethically. In M&A due diligence, for example, seeing a clean record on conflict management is a huge plus. It de-risks the target.
Makes the company more attractive.
Significantly more attractive. And it's absolutely crucial for attracting and retaining top-tier independent directors.
Right. Experienced directors will look closely at this.
You bet they will. Before joining a board, seasoned directors do their homework on the company's governance culture. They know the risks. A sloppy approach to conflicts is a massive red flag.
But a clear, well-documented process.
That's a green light. It signals a professional, secure environment where their own reputation and liability are protected. It helps you attract the best talent, which strengthens the board, which benefits the company. It's a virtuous circle.
So robust conflict management isn't just a burden, it's actually building value.
Precisely. It's a tangible asset.
Okay, we've really dissected Article 4417. But it's important to remember this doesn't exist in a vacuum, right? There's a bigger picture here.
Absolutely. You have to see this meticulous application within the context of, well, ever-increasing regulatory scrutiny on governance, on substance, on transparency, not just in Luxembourg, but right across Europe.
Things are getting tougher generally.
They are, and recent laws definitely amplify the importance of getting these fundamentals right.
You mentioned a specific law earlier.
Yes, the law of 17 February 2025. It's significant because it amends the 1915 law to deal specifically with complex cross-border operations, transformations, mergers, scissions.
Moving companies or parts of companies between countries.
Exactly. And these complex deals are, almost by definition, fertile ground for new and intricate conflicts of interest. Think about it. Layers of entities, different jurisdictions, multiple stakeholder groups.
More potential clashes of interest.
Way more potential clashes. Let's take our director, Rossi, again. Luxinvest Global is merging with a UK firm. Rossi is a director at Luxinvest. She's also maybe a potential director for the new merged UK Lux entity. And maybe her family office has a stake in the firm valuing the UK target.
Wow, we got multiple potential conflicts there.
Right. Her interest in getting the new directorship or her family's interest in the valuation firm's success, that could easily clash with her duty to get the absolute best deal purely for Luxinvest Global's current shareholders in the merger itself.
The share exchange ratio, asset valuation, all potential conflict points.
Every single one. So this new law, by facilitating these complex cross-border deals, implicitly raises the stakes. The decisions being made are bigger, more strategic, potentially involving the company's very domicile. Making sure Article 441-7 is applied flawlessly in these situations becomes absolutely critical for the legal resilience of these major strategic moves. Precision moves from important to indispensable.
That's a really powerful illustration of the evolving landscape. Okay, we have covered a lot of ground. Let's just quickly hammer home those 3 key takeaways one last time, make sure they stick.
Good idea.
Takeaway 1. Article 441-7 is your friend, not your enemy. It's the pathway to legally validate a conflicted transaction, not a roadblock. Use it correctly, and it enables business.
Takeaway 2, those board minutes. They are your #1 legal shield. Treat them like a legal contract. Detail is everything. Prove not just what was done, but crucially, what wasn't done. No participation by the conflicted director in the discussion or the vote.
And takeaway 3, that normal conditions exception, it's a trap. Seriously. If you have any doubt, declare and recuse. The risk of getting that subjective call wrong is just far too high compared to the small effort of following the full procedure. Don't risk it.
Couldn't say it better myself.
So as we wrap up this deep dive, here's something to maybe mull over. In this world of increasing complexity, cross-border deals, intricate structures, could getting really good at anticipating and proactively managing these conflicts, maybe even before they fully crystallize, actually become a genuine competitive advantage, a way for a Luxembourg SA to really stand out when attracting global capital and top talent?
That's a great question to leave our listeners with. This podcast is meant to be a collaborative, free resource that improves over time, so your comments or requests for new topics are highly welcome, especially on YouTube. We want to be a helpful strength for everyone working in the Luxembourg Financial Center at all levels. We are often asked how you can help us. Well, a great way to help is by subscribing to our shows on all major podcast platforms, including Spotify, as well as on Apple Podcasts, where a 5-star rating would really help us. You can also like our videos and subscribe to our Rigore Media YouTube channel. All relevant links will be available in the show notes. For our French-speaking listeners, you can also find our sister podcast in French. It was the Luxembourg Fundcast for you today.
This podcast includes content created using artificial intelligence tools. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance.